Hello, everybody. Mathew Owens here, California licensed CPA and full-time real estate investor, and welcome to How to Analyze a Real Estate Property. One of the most important things in the world to learn is the strategies on how to correctly analyze these types of properties. And after about 10 years plus, I was still finding deals that had costs that I was unaware of or didn't think about previously. 10 years into the game doing this. I've been investing full time for over 15 years right now. And just to give you a quick 2-minute overview of a little bit about me before we get started here. And a little bit about what I do. So I'm a CPA. I graduated with a degree in economics with an emphasis in accounting in 2002. And I've had 15 years of management experience and real estate experience, 15 years of taxation and auditing experience as well. So I've been doing this for a long time. I've now flipped over 1,000 houses. So I know 1,000 ways of new costs that can come up on a property and ways to lose money on a property. So really, really important to be able to understand your cost structure here. We are currently buying about 5 properties a month. We have over a 1,450 unit total unit portfolio of assets, including our individual holds and syndication investments. And then we do a lot of value add multifamily properties in different markets around the country. We have over 35 million also lent to flippers in different markets around the country. And I've raised over $150 million for real estate over the last 15 years for our deals and other outside deals that we work on. We also do a lot of different seller finance strategies and lending strategies that we work with when we're dealing with our properties, whether we're selling to homeowners or people's IRAs or 401ks or other investors on financing. We find strategies that work for everybody involved. And then we develop passive portfolios of cash flow investments for ourselves as well as our larger private investors, and build portfolios for those investors and do the asset management structure to set that up for people and help investors create that financial freedom in their life. We also help with the tax mitigation strategies and helping people get massive tax deductions in year one through cost segregation studies and other types of different strategies that we utilize to help people mitigate those taxes. And then we also run or help run a nonprofit organization called For Investors by Investors that teaches financial education and real estate education without a sales pitch involved. So we've been doing that since 2008. It's been a great resource to learn and develop a lot of the resources you need to do this business. And so let's get into it. How to analyze a real estate property. So the first thing we're going to do is we're going to break down the math, of course, on a flip. This is the most important thing. I see very, very experienced investors getting this wrong because they're estimating a little bit too much. They're ballparking things and they end up losing money on projects because of this. We're going to deal with the market value analysis and go over that aspect of things, the renovation analysis as well. We're going to go over the expense estimates and due diligence you have to do on your flip as well. And then the quality control, which is extremely important long-term to make sure that quality control is in place. It will solve a ton of problems by being able to have the right quality control in place. We're going to analyze it as a rental, and also talk about the lending aspect and how that plays into the rental environment. And then go over some alternative exit strategies that exist, because whenever there's changes in a market, you want to know every way to get out of a house or every way to create more cash flow or a higher return on investment for yourself by utilizing alternative exit strategies that exist. So these are all the different things we're going to go over right now so that you guys get as detailed of education as I can give you about analyzing a property. So let's first break down that math, okay? So breaking down the math of a flip, you always start off with what's your after repaired market value. So you're going to look and find out what that looks like for a fully renovated property on the market that's around your same square footage to come up with your general estimate of your market value. And in this example, it's 160,000. And then you're going to take out commissions and take out your sales closing costs. You also might have some inspection items or something like that that goes into this, coming down to your gross proceeds involved. And remember, we're backing in to our purchase price across the board. Okay, so and sometimes you may not have commissions, you may be a realtor yourself, maybe you'll get a discount. I always think it's a good idea to try to make it work, even if you're paying max commissions involved. I wouldn't buy a property and look at your margins any other way. So purchase price is 80,000, rehab in this example is 30, interest and points, appraisal, insurance, closing costs, title, and loan fees involved, coming to your total cost of 124,000 in this example, which is 77.75% of the $160,000 estimated market value. Now, in this case, you're going to include your profit, and you really want to be hitting around a 15% margin right now, if you possibly can. Sometimes people will go down to 10, but with renovation buffers and all that stuff involved, then you want to be trying to hit a 15% just to be on the safe side. And so typically in this case, if you take the $148,000 gross proceeds minus your total cost of 124, you come up with a $24,000 profit, which is a 15% margin on your $160,000 market value. So typically, you're going to take all your other costs. You're going to say, here's my gross proceeds minus my rehab, my interest and points, my appraisal and insurance, and my closing costs involved. And you are then going to subtract a 15% margin coming down to your purchase price and saying, this is what I'm willing to offer on the property based off of my margin, because you want to pay yourself first with regard to the profit. And then if you were to get a loan on it for 110,000, which is your purchase and rehab in this example, then you'd be at a loan about 68.75% of that after repaired market value. And you'd have to be putting down about $14,000 in a total down payment on this particular project, just in this general example here. There may be some increase in fees. There may be some increase in closing costs. There may be some other minor costs here that are not included. Maybe some of the other ones that you want to include are your marketing costs, so you can build that into every deal and see what your true profit is after your marketing costs involved. There are other miscellaneous costs, some utilities and things like that. Usually I build in the utilities and the renovation buffer and inspections into the rehab costs, so that that's all included in my renovation costs across the board. Okay, it works out better for the financing if you're able to include those costs inside your rehab and not coming out of pocket for those items. And you always want to have reserves on the side on top of that 14,000 for renovation overages, for fronting renovation costs before you get it reimbursed, as well as for overages in timeline where you have to pay additional interest and things like that could come up. Okay, so this is the basic math that you want to be taking a look at. Okay, and then you have your market value analysis. This is one of the key things where a lot of people get this wrong. A lot of investors, they're too aggressive because they want to make a deal work. If you're not being realistic for yourself, you will lose money on the back end when you're trying to sell these properties. You need to be very, very, very careful. And in an up market, you're able to pull maybe the last 6 months of comps. In a down market, you want to be looking at the last 3 months and even pendings and active listings even more carefully, and putting more weight to those if you're looking at a potential down market or reduction in market values in the future. So depending on the market, what you're looking at those factors. And so what I do is I take all the comps that you can find and you go through and do a detailed analysis. So you're looking for comps that are around your same square footage and that are comparable to your property. So same type of renovation that you're going to be doing after the fact. So that way you can get comparable. You want to really be within a half a mile of that property and put the most weight to the things that are the closest to that property. And you want to be within the last 6 months. An appraiser is going to use the last 6 months and put more weight to the last 3. They're going to look at the closest properties as the closest comparable. And so you're coming up with those average sales prices, and then you have to recalculate those comps based on an appraisal adjustment, which is what we use. And usually you're looking at $35 to $50 a square foot as an adjustment. It really, really depends on what your cost per square footages on that particular asset for those appraisal adjustments. You may want to bump it up a little bit on higher cost per square foot properties versus the lower cost per square foot properties, those appraisal adjustments, plus making adjustments for beds and baths and things like that, and adding a increase or a decrease to your calculated amounts based off of the beds and baths and what an appraiser might be looking at when looking at your property. Does your property have a pool in it? Does your property have a basement in it? Does your property have a deck or a view, or being on the wrong side of the street? What is your property that you're comping out in comparison to these other ones, and make those detailed adjustments to each individual comp to come up with your general estimate. And you can see here in this estimate, we were looking at about a $465,000 estimated market value. And so where are you going to find these comps? The first place is the MLS, one of the best places to find them. You're going to look at Zillow, you're going to look at Redfin. You got to put less weight to some of those things, and you really, really need to make sure you're comparing apples to apples, because they could have old pictures, they could have, you know, outdated information. A property on there might have a comp, but it needs full renovation, or maybe it looks like lipstick, but the systems are bad. There's so many factors that can go into these things. You're getting a general estimate, and then you really need to dive deeper into each and one of these individual comps to find out what that looks like. PropStream or title companies or other data sites online also have comps. You can also get, you know, go to the local recorder's office. There's a lot of properties that are sold that are not on the MLS, that are sold privately. So those types of comps, you want to look at those local recorder's offices and things like that to see what else is out there that you can compare it to when you're calculating these things. And if all else fails, go get your team members involved. Go get a realtor that knows that specific area. Go get an appraiser that you can check and balance your numbers on. It's worth the fee to have that sanity check on your numbers if you're not sure in that market. So key items to focus on: the street dividers. A lot of investors don't realize that, hey, one street is a completely different one across the street. There's street dividers in cities where above a certain street might be, you know, $100,000 plus difference than below a certain street, because of the neighborhood difference and the stigma of that street and what it defines as far as neighborhoods. Very important to pay attention to in those specific neighborhoods. Walk that neighborhood. If you can't be out there, do it online, do it on Google. Pay attention to when that picture was taken. As far as the year goes, that's all on there as well. Have other people go out to these properties and walk these neighborhoods and things like that too. One good check is to pull out your comps, look at everything, and then have somebody on the ground do a drive-by of each one of these neighborhoods in these areas to find out if that neighborhood is comparable to yours, and take detailed notes on those comps. Okay, so the time frame and the distance we talked about, extremely important. Looking at those pending and active listings, also extremely important when you're dealing with market volatility and fluctuations in the market. And school lines, also very important. You could have one street that across the street, it is a different school district, and people pay for school districts in certain lines are very, very important. So similar properties and quality, another big factor. Some people choose the highest, you know, HGTV house for comps across the board, that's fully furnished and staged and all that stuff and ready to go, versus a property that someone may not have the right finishes, may not have the higher end materials and higher end appliances and things like that. So you have to pay attention to that. Those things will make a big difference in your price. Okay, so when you're analyzing your market value, these are the primary things that you really want to pay attention to. Okay, renovation analysis. Looking at the market values and looking at the renovations are the biggest problems when I deal with flippers in different markets, where they're wrong on their numbers here, especially now when there's supply chain delays, when there's renovation overages and things like that to consider. And so what I typically do is I have this quick and dirty analysis where I have borrowers go through, or I do this on my own deals, where we go through and say, okay, let's outline all the major systems, the exterior, the interior, and other with regard to major systems involved and appliances and HVAC systems. And then looking at the interior, you know, what general repairs need to be done, what kitchen appliances need to be replaced, what kitchen cabinets and all that stuff in the kitchen, the lighting, the exterior aspect with the gutters and the fascia and the roof, and the yard is a big one, and even door locks and things like that can add up. And so being able to kind of put it in this way where you can outline what your estimated major costs are on the project, including a renovation buffer and renovation management, so you can have eyes and ears on the ground on your project, so you don't have to be the one doing that, is very important to outline in detail, so you know you're not missing anything major with regard to the project as a whole. Also, when you're getting renovation bids from contractors, you can determine, hey, is that in line with what I was expecting, or is this above budget or below budget? And can I get a breakdown of that bid in particular? You know, if it's a roof and it comes in at 20,000 when you were expecting 12 to 14, why? Can you get extra quotes? What are the reasonings behind? Are they using a certain type of material? Are they not, you know, using a certain material? They're giving you a layover on a roof. You know, all of those different things get kind of worked out when you break things down this way. Okay, so you're looking at the major systems, the plumbing, the electrical, the HVAC, the roof, the appliances, the water heaters. All of those major things are key factors as far as cost goes. And those are the things that have massive overruns. And you're also looking for major issues with age, like plaster on walls and things like that that need to be, you know, if something needs to be completely regutted, you might have some framing issues on older properties, that kind of stuff that it could be a major issue that could come up. Okay. Quality renovations, you know, like I mentioned, what are the materials that you plan on using? So you have to get very, very familiar with what these costs are. And if you're a newer investor, get your butt over to Home Depot and Lowe's and all these other suppliers and price out all the materials costs, and then talk to contractors about how much time it might take to do the flooring in a house, or do the roofing on a house, or the plumbing or electrical, or those different aspects, so you can gauge how much of an hourly rate they're charging you, because you'll know the materials side of things and you can break out the labor and say, this is what my true estimates are on these projects. So, and you have to have proper quality control in place. You want to go get those inspections before you list the property, so you're aware of these major issues that will scare off a buyer. You want to be able to go through and give them all the information, so that way you don't have problems that come up where something falls out of contract and then gives you another 3 months on the market, because now it's been a long time sitting on the market and people are lowballing you and all that kind of stuff, all because one person backed out because the inspection came back ugly for some things that your contractors missed and you didn't have the proper quality control in place. So get inspections after the renovation is done. You do walkthroughs of these properties. You get pictures of all major systems. You have all the punch lists done. Then get a full inspection on this thing and be able to make sure all of those items in the inspection list are taken care of. And you have side-by-side pictures of these things. So if you are a buyer, you are getting a package saying, here's the inspection we did, and here's the side-by-side pictures of everything in the report showing it's done, so that you are aware of these things up front that existed. Feel free to get your own inspection. By the way, you can't rely on this information, but it stops a lot of fear in the market as a whole. So in getting those inspections are absolutely key, and having an inspector that walks you through that inspection report, that gives you the knowledge base of what's wrong with the picture there, is very, very key. And you have to do your due diligence on contractors. We've been stolen from so many times from contractors. Even if we're doing the due diligence, sometimes it's hard. You want to make sure they have the right insurance. You want to make sure that they have a good reputation. Get some referrals of other people they've done work for. Look at those pictures of their previous finished product and what that looks like as well. Go through the ringer with these people. Make sure there's no, issues. Do a background check. Make sure you have the right contracts in place with these contractors. subcontractors as well, and they're properly licensed and they're pulling all the permits. Get copies of your permits, because a contractor will lie to you and tell you they did a permit when they didn't. So these are the things that are important on that contracts and the insurance piece with regard to this. And they have to have the right general liability insurance. They have to have workers' comp insurance, all of those types of things. And you want to get lien releases as they make payments to their subcontractors so that you don't end up with a lien on your property. So getting those builder's risk policies in place also, when as far as your policy, if you go get a policy that is meant for a renter and you have a claim, the insurance company is not going to pay you. So you need to get a builder's risk policy because it's under construction and probably going to be vacant for over a month. So once it's vacant for over a month, then you need to have that construction policy in place and that renter instead of the renter's policy. So going over the renovation analysis further, just to show you how detailed this can get when you're outlining materials and labor and tax, and you're estimating, hey, that screen door material is this. It's going to take about an hour to go put in the screen door, maybe at $50 an hour, and that's going to cost me $193. Okay. You want to go through this thing with a fine tooth comb. This is how you learn how to break down a rehab in detail so that you don't go over budget on your projects and you have everything allocated. And sometimes your labor is going to be off on this, of course, because you're just estimating, but at least you have a gauge to go by when you are getting bids from outside contractors saying, hey, that's way too much for the outside of this property or the inside of the property or the full project as a whole if they're quoting you materials and labor. So same thing with the mechanical and the other miscellaneous items. You want to put in utility bills, you want to put in landscaping, you want to put in your roof and their cleaning costs after you're done, rehab management, the gutters, all of the different things associated with the systems involved in the property. This is just a general breakdown of two of the different components of a rehab. And then this is one for the living room. We're actually measuring the linear feet of these things so we can gauge the paint involved in the paint and the labor and the costs involved, including the doorknobs and stops. And you can see how detailed some of this can be when you're trying to estimate a renovation. That's why I do the quick analysis sheet, because in the detailed side, it takes quite a bit of time to really go through and get this dialed in until you have a template set up to do this. So the renovation analysis should also come with a timeline involved. So you got initial pictures, your cost estimates, and you can see here we have a drive-by area, and then we have a plan to purchase area for all the tasks that get involved there, the renovation, the budget detail associated with it, and securing the house and installing new locks and doing a detailed walkthrough with a video and getting all the dimensions and the layouts of these things, getting your inspections and utilities on, getting your budgets finalized and your inspections finalized, and then starting your renovation all the way through marketing, inspection after the fact, and that follow-up after the fact with regard to your quality control, and then moving a tenant in or getting a property handed off to a realtor for sale afterwards, updating your final comp analysis and your final numbers one more time at the end of the project. I like to do it multiple times through the project to make sure that I'm on budget and can have my right exit strategy, because you may not want to sell a house if you're thin on margin and it makes more sense to cash flow. Or if you're over budget on a property and the cash on cash return is too low, you may want to go resell that property. So analyzing that after the fact is absolutely key. Okay, expense estimates and the due diligence associated with this is absolutely key. So like I mentioned, getting your commission expense and your realtors lined up front so you know what you're going to pay in commissions is key. Understanding what property management costs, understanding, hey, is it going to be an 8 or 10% management fee? What other costs do they have? Do they have a lease renewal charge? Do they have a leasing fee? Do they have a markup on repairs? What are your costs involved on the property management side of things? Is there a setup fee or anything like that that exists on that property management? Knowing that number up front is absolutely key depending on the market you're working in. Understanding bad debts and vacancy. So it depends on the housing. I typically use 5 to 8% as a vacancy allowance on my single family homes. On a multifamily, I might be using 10% just because maybe it's an 8% vacancy with a couple percent in bad debts that I want to add on to that as well. But you should be including a vacancy allowance and bad debts in your cash flow analysis here. Your property taxes are a big one, whether you're dealing with multifamily or single family homes. If you are buying at a basis that is above, at a tax basis that is above what the current owner's basis is from a tax perspective, chances are the property taxes are going to rise in the future, and they typically reassess sometimes every 5 years, sometimes on sale, and it depends on the state and the market that you're working in. Should you be going through and reestimating these property taxes, or should you leave it and say, hey, it's going to reassess in 4 years and this is what the new property taxes are going to look like at that time? You got to get the property tax calculator out to make sure that you know what that new number is going to be. And if you don't know how they calculate it, call the city and find out what their actual formulas are when they analyze these, so you can get the best estimate for what new property taxes are going to be. So insurance, very, very key. Do you have full replacement cost coverage on your policies? Absolutely important. Do you have loss of rents coverage? What's your liability limits? Typically, we like to see $1 million liability limits on our properties across the board, so that way we're covered and protected, and then we still put it inside of LLC structures so that way we have additional liability protection on top of that. And what are the perils that they've taken out? Are they going to cover wind damage and water damage and those types of things when they come up, or vandalism and theft on a rental policy, or electrical fires? They're going to do everything they can to not pay you on a policy. So going through and getting the right insurance, making sure you understand what the deductibles are and that you're dealing with an insurance company that pays you if there's a peril is absolutely key. So going with the right agency or rating as well as key. So repairs, always putting in a repairs allowance on your property is very key. We typically use $100 a month in our single family homes, sometimes up to $200 a month. And then we, depending on the square footage and the size and all that kind of stuff. And then also going through and doing that on multifamily. For doing that, maybe it's $75 to $100 a month per unit in a repairs and replacements cost. So we also have CapEx. So if you're not putting a new roof on your house or on your property that needs a roof in the next 5 years, then you are going to take the cost of that roof and divide it by the number of months until replacement to take that out of your cash flow to then replace that up front. I usually, if it's got another 5 years or left, I'll usually put that money in up front as if that is a reserve, because I don't know at what point it's going to fail. So you include that in your upfront renovation costs anyways. Even if you're not going to replace it right now, hold that in reserves, because that item is going to be needed. And if the deal doesn't work with that in place, then don't do the deal. Simple as that. Utilities, also estimating what tenants pay for, what you pay for as well. Sometimes there are sewer charges that you continue to pay. Sometimes there are, other charges that you want to get on the tenant. Obviously, there's vacancies, so you want to allocate and put some utility charges for whenever you have a vacancy. So, and then getting your inspections. What is your inspection cost? You have re-inspection costs as well. You also have pictures and video costs and walkthrough costs and things like that you want to estimate in your total costs and doing your homework on these deals, so you know your true numbers. Because the last thing you want is not finding out about a cost like an HOA or something like that exists that just destroys your cash flow. Okay, so let's talk about that quality control. We go through and get layouts like this on the property, so we know what our general layout is of that property. We have that for marketing purposes, as well as for insurance purposes, as well as for all different types of utilizations of this, including cost segregation studies and that type of stuff to get the tax benefits up on that. So you want to outline all the major systems like I discussed, get the property layouts You want to go and get inspections before and after that renovation and get side-by-side reports of everything in that inspection report being done. Very, very key under your quality control. You want to make sure you're outlining all of your punch list items and that those things are done, and verifying those are done and done correctly. You know, you find a blotch on the wall where there's a mark or something that needs to be repainted. Sometimes they'll come in and paint one spot and it looks totally different from the rest of the wall, and it's very hard to see in pictures, but in person it's completely obvious, you know, that that's occurring, right? Having those eyes on the property from someone that knows what a good and bad renovation is, someone that is expecting a higher end, nice property that isn't going to let you buy on those little minor deficiencies that really affect your sales price at the end of the day. Sometimes not everyone has that eye for those items. I'm not one of them that has that eye. I need someone else to go through that. I'm an accountant and look at this from a numbers standpoint. I am not the person that does the designing and all that stuff. So getting proper marketing pictures, absolutely key. You do not want pictures of half of a room where you're dealing with walls. Get a wide lens camera and take pictures of the entire thing with a wide lens camera so you can truly see what every room looks like. Get multiple angles of the outside and inside. Get a video walkthrough as well, so you have all of this stuff documented. It's hugely valuable. Even if you're holding a property long-term for cash flow, you need that for marketing tenants. What if you want to sell the property in a couple of years and you don't have pictures because the tenant's in there and things like that? Now, getting those marketing pictures are absolutely key. And then getting your warranties and your serial numbers of all your appliances and everything that you spent on the project is absolutely key. Making sure you have that contractor's information handy for any warranty work there as well is key. Making sure you're dealing with contractors that will warranty their work too. So you're not going to pay the cheapest price for a quality contractor, but you will get, you know, quality work done and people that'll hold themselves accountable to that work. So let's talk about analyzing a rental, okay? A completely different strategy that's absolutely very, very important than, you know, as that sale on the back end for a flip project, okay? So first thing is you're going to do the same type of comp analysis. You're looking at, you know, the MLS, you're looking at the Zillows, you're looking at all those things to find these comps, and you're seeing what is my competition out there right now? Where are these rentals being marketed, and what does that look like for competition with my property right now? Sometimes it can be all across the board, and you really, really want to compare your property versus, you know, the competition's property, and based on your square footage, based on your bed and bath, all of those things are extremely important when you're analyzing a rental, to come up with your rental estimate and then verify these numbers with property management as well across the board. So you want to get your rent projections in place, okay, and understand what you think the market rents are going to be. Outline your expense projections, just like we talked about previously with the taxes and insurance and repairs and vacancy allowance and management and all that stuff. And then you're going to look at what is your cap rate, which is what is your total cost, what is the net cash flow after all your expenses if you paid all cash for that property. So if you are paying $100,000 for a property and that's your all-in cost with renovation, and it's making you $10,000 a year, then that is a 10 cap. You're making 10% return on investment if you paid all cash based on your cost, okay, involved. And you also want to get your cap rate at what your market value is, which is different from your cost as well. What are your financing options out there? Are you getting a 30-year fixed? Are you getting a short-term construction loan and then refinancing into a long-term deal there as well? What are those rates and terms and monthly payments look like? I would highly suggest getting the 10BII financial calculator. They have one on iPhone. You can buy one where you can do it as well, a live calculator, but there's one online that you can buy. It's a red app on the iPhone. Great quality app to utilize when you're analyzing these financing projections. So what is your cash on cash return? So after your total costs and you cover your net income minus your loan payment, what is your cash flow versus now your down payment versus the costs involved versus your, you know, total purchase and renovation, what is your net down payment after you've gone through the refinance or finance that property, and versus the cash flow after your debt service. And then you have your principal reduction every year on that loan. You have your tax benefits, and then you have your return on investment analysis that you need to be doing and saying, what is my cash on cash return? What is my principal reduction every year? What are my tax benefits a year, to come up with my true return on investment analysis when you're analyzing a rental. Okay. So here is some basic math. If we have $1,600 a month in rent for 12 months, that's 19.2 minus vacancy and bad debt minus management, taxes, insurance, repairs, and CapEx. The net cash flow is $8,798 a year in this example. And then you take out the loan payment, which is $499.65 a month in this example. And that net cash flow is $2,802 a month in net cash flow after your loan payment. And then you're going to add back your principal reduction to the cash flow. So you're really netting $3,987 a year in principal reduction and cash flow. And then you also have some tax savings based on, this is based on a 35% tax rate for federal and state. Just to give an estimate involved, your tax situation may differ based on your actual tax rate. So you're making $5,107 in cash flow, principal reduction, and the tax savings. So let's do the math here. If you are buying it based on that previous example for $110,000 in a purchase price, and you're putting 20% down plus $5,000 in closing costs, that is a total down payment of $27,000. And so I'm assuming this property is fully renovated and done already. Obviously, you could be buying a property and renovating it and being in it for 110 and then refinancing. And this same math may apply across the board doing that strategy versus just buying one and putting 20% down. And so in this example, you're in it for $27,000 with your down payment and closing costs. And you have a loan amount of $88,000. So the 110 minus the $22,000 in down payment is $88,000, and your monthly payment is $500 a month at a 5.5% interest rate for 30 years. You may get a little bit lower of a rate. You maybe get a higher rate depending on your down payment, depending on your credit score. All of those factors, play into your actual down payment amount. But this is the math that it works through. So it is a 7.99 cap rate on the $110,000 market value. So remember, cap rate is based on all cash. So your net annual cash flow for all cash is $8,798 divided by your purchase price, or your total cost on the project of 110, is a 7.99% cap rate, which just means that you will make 7.99% on your money if you bought this property in this example in all cash. And then you're looking at your cash on cash return. You're making $2,802 divided by your $27,000 down payment, and that's a 10.38% cash flow return on investment. And if you added the principal reduction as well, you're making 14.77%. And if you add the tax benefits on top of that, you're looking at 18.91%. And that is not considering front loading the tax benefits into year one and getting a massive tax deduction. Usually I'd say 20 to 30% of your purchase price as a deduction in year one for doing a cost segregation study. And each property is a little bit different. So you have to get the analysis done by an outside professional for the cost seg studies. And we have team members that do that for us in-house. So alternative exit strategies. So sometimes you get stuck with a property and you need to know what's out there, how to get more spread on your deal, how to make more money on a deal, or get out of a property. Okay. So you can obviously flip or hold it. That's two strategies as far as what I'll call an exit, even though holding's a long-term deal, but you're positioning it into a buy and hold asset long-term. So I call it an exit. You can also do seller financing to a homeowner, or seller financing to another investor where you're being the bank. So you're turning your actual property ownership into a promissory note, and you can own this long-term for cash flow. Okay. wraparound mortgages. You can get an existing loan in place and sell that property on financing as well. You got to watch out for the due on sale clause. So many times you need to sell in a land contract or put the property in a trust and making that buyer a beneficiary of that trust, so that way the bank doesn't call the loan due on that loan. Really important information to understand when you're doing these strategies on wraparound mortgages, to be very, very careful. Okay, short-term rentals is another exit strategy that you can implement on top of the normal buy and hold structure. Sometimes properties work really, really well from a short-term rental standpoint. So whether you're doing the short-term rental yourself or selling the property as a short-term rental, the cash flow can be a lot higher as long as you have proper management in place, which is absolutely key to the short-term rental business. Unless you want a full-time job, don't manage short-term rentals yourself. It's a lot of work. Okay. You can do joint ventures with investors where they can put up cash on these deals, or they can get the financing and put the cash down, and you can have the property ready to go, and you bring in a partner and you own this long term with those partners, and they can be in it for your cost or something along those lines. And you can still get a piece of that long term cash flow via a joint venture and not have to put money down yourself, or not have to get the financing yourself in place. And then there's always funds and syndications. You could always hold properties or sell the property to a fund or a syndication, or be able to hold it long term with other people's money via these means too. And so here is the math on a wraparound mortgage, just to show you the power of this. So in that previous example, everything's the same $27,000 down, $88,000 loan, and your all-in cost on the project is $110,000 with purchase and renovation, and your monthly payment is $500 a month. Now, if we sold it for $150,000, because if you're buying the property right, you should be having some built-in equity into this property. You should never buy a property wrong. You got to buy it right. And then you offer it to a homeowner with 10% down, so call it $15,000 down, minus full commissions, which you may not have commissions selling to a homeowner. It just depends on what your marketing strategy is, because you can sell it yourself versus on different for sale by owner sites, or on Zillow or Redfin or a bunch of other online sites, or maybe you're a realtor yourself and so you don't have to pay commissions. But in this case, let's build in the commissions so it looks worse than what it may be, and minus closing costs. So your net down payment is only $4,500, but that pays for any foreclosure costs that might come up on the project. So if you ever don't get paid by that homeowner, you're in good shape here with being able to not be out of pocket anything if you have to foreclose on that project. Okay. So remember, you're in it for $22,500 down now, because you went and took your $27,000 down payment minus your net cash out of the down payment of $4,500. So you're only in it for $22,500, and you have a seller finance loan for $135,000 now, which is your 150 grand purchase or sales price minus the $15,000 down payment. And you could potentially sell it for an 8.95% interest rate, even though you have a 5.5% interest rate. And so the monthly payment difference is $1,080 a month, or the monthly payment is $1,080 a month that you're collecting, and you're only paying $500 a month. So you're netting a profit of $581 a month, which is $6,972 a year, or a 31% cash flow return on your $22,500 down. And if you're doing what your return on equity is, which is the return on investment is basically your 135,000 minus your $88,000 loan is your existing equity in the property, so $47,000, and you're making a 14.83% return on your equity in the deal. So you want to analyze it both ways when you're determining if you should sell a property or hold a property. What is my current cash on cash return versus what my return on equity is? If you're only making 5% or something small on your equity, sometimes the value of the property went up high enough, it makes sense to sell it, or you just want to liquidate the note and be able to get that money back. You can absolutely sell this note off as well and sell that $135,000 $35,000 note and pay off your $88,000 loan and make that difference, or just sell a piece of your loan. So then that way you're in great shape with being able to not be in it for anything and get your equity out and maybe even still make some spread. So your homework today for the analysis course is, first, I want you to pick 5 properties off the MLS that are actually active right now that you can analyze, okay? And I want you to analyze them all from a flip perspective and break down all the math on the deal, just like I did previously in the presentation. You can break it all down. And then I want you to analyze it also from a hold perspective. Always analyze it from a flip and hold perspective so that you know what multiple exit strategies exist on that asset. I even go so far as to analyze it on a seller finance projection and understanding what that looks like too, or a short-term rental, depending on what the strategy is. Outline all the comps for each of those 5 properties. Get really, really good at that. And then go to your realtors and your professionals in the area and understand what those properties really comp out at, to see what you did wrong when you're analyzing these, okay? Outline a detailed renovation bid for each of the 5 properties. So then that way you can understand what those costs are. Go to Home Depot, understand the materials, try to estimate the labor as best you can. This is all a process in learning how to go through and analyze a property correctly. You should be able to walk through a house and know by the end of that walkthrough what a renovation generally is going to cost you. That's what the goal is. You can become super proficient at analyzing these renovation bids. And then line up your financing sources and go make offers on all 5 houses. Remember, you're backing into your purchase price after profits, and who cares if you don't get the property under contract? Go make the offers. And if they have something higher, say, hey, I'd love to be in backup position. I can pay all cash, do those types of things, develop the relationships with the realtors, show the realtors your math on these deals and say, this is why I got a lowball the offer on this, or this is why I came in at this price, is because here's my math, here's my breakdown of the total costs involved. If I'm wrong, let me know, but this is my pricing. I'd be willing to pay cash at this price, and get in the habit of making those offers over and over and over again. So if you like this webinar, please feel free to take a look at a couple of our other ones. We have one on how to market and find deals, where we go over the infrastructure and the team you need before you start, who are your sellers, how you can help them to get a discount on the property. You don't have business getting a discount or property unless you find a way to help that seller. Who sees the properties and the problems that exist on properties, so you can market to them and get more deal flow. How to market for properties in detail, all the different strategies that I utilize and that others utilize to market properties, how the tracking system and the follow-up system should work, and then how to use automation and put the right systems in place. And then we have one on a webinar on strategies to raise capital for real estate, which we go over the debt and equity strategies, the syndication documents and operator due diligence and the different structures involved in these syndications, the securities laws, the investor protections, like what risks exist and how to mitigate those from the loan to value and collateral standpoint, the education you need to have in order to even raise capital in the first place, and what things you should be knowing that your investors are going to be asking you, so that you can be an educated investor before you even try to reach out to people, because you will not raise money if you don't have answers for those investors. So understanding some creative structuring involved when raising capital, and then note strategies and things like that and the pros and cons associated with that. And if you liked this education, this is very similar, except for a lot more in depth, for a real estate course we have coming up. It's a full 6-month course on every aspect of real estate investing, 25 full courses just like this, with live Q&A sessions every single week for investors to get all your questions answered. You move forward in the right direction to be able to buy these assets and start building financial freedom for yourself. You're going to get all the tools to build that financial freedom. And we have a complete, well-rounded real estate course on everything you can think of, from running a business to investing investing in the right tax strategy investments and the right legal and tax structures and IRA investing, raising capital, all different types of stuff. Interviews with specialists in those fields, from CPAs and attorneys and other financial planners and flippers and contractors and property managers and every single team member, so that you guys can understand what makes a good team member in every single category as well. So you're going to get all the contracts, all of our checklists, all of our quick analysis tools, where we have analysis tools where you can plug in 5 numbers into a single family home and know right away if you have a deal or don't have a deal, and what your purchase price needs to be on that asset, where you can analyze a property in less than 5 minutes every single time. So, and then once you complete the course, because I want you to have experience, I want you going through all these details and knowing all this right information, then we will absolutely help you with getting deals and help you supply you with deals, as well as providing you financing associated with this on your own deals. We'll actually lend you capital for your own flips and potentially even joint venture with you and do those types of strategies as well, and bringing those resources to the table so that you can build a cash flow portfolio utilizing our money and building that cash flow stream for yourself. So we don't accept everybody. This is a big commitment. It's a 6-month course. Expect there to be homework. Expect there to be a couple of hours a week of not only the video time of me teaching the courses, but also the live Q&A sessions, also the homework involved. So I would assume it's somewhere around 5 hours a week of your time that you need to be able to be committed to learning this stuff. I don't want you involved if you don't have the time to do it. I don't want you involved if you're not going to follow through. I'm not one of these get rich quick type guys that is going to come out and say this is easy. You're going to take some punches along the way. I'm here to help mitigate that risk and help you have a well-rounded experience, give you all the tools and the strategies and the knowledge base so you don't lose money right off the bat. And I want you to be able to be extremely successful. And you can go to our website at becomearealestatemaster.com to learn more about this. And here's the example of all of the curriculum involved. We're going over your initial goal setting and how to run a business and how to outline what your goals are so you can get to exactly the picture you want to be at and actually running that business in detail, the different investment types that are out there, and an overview of those strategies in detail with paperwork and all the backup associated with each one. The right financial education from a business and personal standpoint, your personal budgeting, your bookkeeping, your record keeping, your insurance, and all that kind of stuff that needs to be in place if you're running a business. How to build your team, 2 full classes on every team member. And we're going over a ton of every team member involved there with those live interviews and things like that as well. The market analysis, how to market and find your deals in the first place, property acquisition process from A to B to C, all the way through the initial purchase to the due diligence, to the closing, to the renovation, to the marketing and quality control on the back end, and the sale or the handoff to management. That entire process is outlined in detail. The sales training when you're talking to prospective buyers, the property management side of things and what makes a good or bad property management company. Absolutely key. We went through 5 managers on every market that we joined, it seems like, before we find the right ones. Insurance planning, tax and legal structures, self-directed IRAs and 401ks, multifamily analysis, understanding alternative exit strategies, lending money and raising capital, 2 full classes on raising money and lending capital to different investors and being able to understand that strategy. Very key to financial success there. And then managing your investments. Something nobody teaches about is after the fact. What does the operations side need to look like to properly manage your investments depending on the type of investment? And then we're going over different case studies so you can see real live examples of these things in process right now. And then we're going over actually making offers and making you guys make offers on these deals, having everything lined up, having your right base and the infrastructure and the foundation built for you to be able to be a fully successful real estate investor and be on your way to financial freedom. So if you have questions, feel free to reach out at info@becomearealestatemaster.com, or you can go to our website, becomearealestatemaster.com, and you will find all the different information about our course. So that way, if you're interested, please feel free to join us. I'd love to have you on board and teach you how to be a full-time real estate investor and create that financial freedom in your life. It's the only way to stop trading your time for money, is to take action and be able to go through and develop these cash flow streams that you can retire off of. Thank you guys very much. I hope you guys enjoyed. Feel free to reach out. If I can be a resource for you in any way possible, I'd be happy to. Talk to you guys soon.